The SEC wants to limit its OTC quoting rule to equities, and crypto classification is the open question. The SEC proposed amendments to Exchange Act Rule 15c2-11 on March 16th, narrowing its scope to cover only equity securities. The rule governs what information broker-dealers must gather before publishing price quotes in the over-the-counter market. Chairman Paul Atkins framed it as a correction. Regulations should be appropriately tailored to fit the asset class to which they apply. The real signal for crypto is buried in Commissioner Hester Peirce's accompanying statement. She wants public comments on a specific question: do crypto assets fall under the definition of equity security? Why a 1971 OTC rule matters to crypto in 2026. Rule 15c2-11 has been around since 1971. It requires broker-dealers to review and verify issuer information, financials, corporate structure, outstanding shares, before they can quote a security in the OTC market. The rule was designed to prevent pump-and-dump schemes in penny stocks. The problem started in 2021. When the SEC adopted amendments that year, staff interpreted the rule as applying to all securities, not just equities. That interpretation swept in fixed income instruments and, by extension, anything the SEC might classify as a security, including crypto tokens. The fallout was immediate. More than 2,000 publicly traded companies were shifted to OTC markets' restricted expert market because they could not meet the enhanced disclosure requirements. Fixed income markets panicked. The SEC eventually issued no-action relief for certain bond categories, but the broader interpretive damage was done. Crypto broker-dealers have operated under this uncertainty ever since. If a token qualifies as a security, and if that security is not listed on a national exchange, Rule 15c2-11's disclosure requirements could apply to any broker-dealer quoting it. What the proposal actually changes. The amendment is straightforward in text. Replace security with equity security throughout Rule 15c2-11. This would formally exclude fixed income instruments, asset-backed securities, and potentially crypto tokens that do not meet the equity security definition. Chairman Atkins stated the proposal would clarify regulatory obligations when publishing quotations and affirm what was always understood. That phrasing is deliberate. The Atkins SEC is framing this as restoring the original understanding of the rule, not creating new policy. For broker-dealers currently handling crypto, this proposal matters in two ways. First, if crypto tokens are not equity securities, broker-dealers would no longer need to comply with Rule 15c2-11's disclosure requirements when quoting them OTC. That removes a compliance burden that has made some traditional firms reluctant to touch crypto markets. Second, it reopens the question of what regulatory framework should apply instead. Peirce's 3 questions. Commissioner Peirce titled her statement, "Traveling Back from the Road Wrongly Taken, a Pointed Critique of the 2021 Expansion." She is asking for public input on 3 specific areas. The definition itself. What counts as an equity security? The Exchange Act defines it broadly, but the boundaries get blurry with hybrid instruments, tokenized assets, and governance tokens that carry voting rights but no traditional equity claim. Application to crypto assets. Peirce wants commenters to address directly whether crypto assets should fall under the equity security definition. This is not a hypothetical. The answer determines whether OTC-traded tokens need the same disclosure infrastructure as penny stocks. The expert market. The 2021 amendments created a restricted tier where non-compliant securities can still trade, but only among qualified institutional buyers. Peirce is asking whether this structure needs reform, particularly as tokenized securities and crypto assets blur the line between traditional and digital markets. The broader Atkins agenda. This proposal does not exist in isolation. The Atkins SEC has been systematically unwinding the Gensler-era approach to crypto regulation. In December 2025, the Division of Trading and Markets issued guidance on broker-dealer custody rules for crypto assets. In early 2026, the Commission began exploring innovation exemptions for tokenized securities trading. The Rule 15c2-11 proposal fits a pattern. Narrow the rules that were expanded to cover crypto during the previous administration, then build targeted frameworks that account for how digital assets actually work. BTC was trading at 75,955, 4.5% in 24 hours, and ETH at 2365, 8.5% as of March 17, 2026. The Fear and Greed Index sat at 48, neutral. The market reaction is not directly tied to this proposal, but the broader regulatory thaw under Atkins has been a persistent tailwind. What happens next? The proposal opens a public comment period. The SEC has not yet specified the exact duration, but standard rulemaking typically allows 60 days from Federal Register publication. After comments close, the Commission can adopt, modify, or withdraw the proposal. For crypto companies operating in the U.S., the comment period is an opportunity to shape how digital assets get classified at the foundational level. The equity security definition touches everything from exchange listings to broker-dealer custody obligations. How the SEC draws that line will ripple through how tokens are quoted, traded, and regulated for years.